Welcome to the People Property Plays podcast. My name is Matthew Watson. I'm your host, and today I'm absolutely thrilled to be joined by Justin Hildebrandt, Senior Managing Director and Head of Europe at Affinius Capital. Today we're going to talk about his background, who Affinius Capital are, and his views and takes on the market. So Justin, welcome to the show.
Thanks for having me.
Not at all. Well, look, I know in the UK and Europe, you and Affinius keep a very low profile. Mm-hmm. Why do you think now's the time to talk or kind of open up and share a little bit about what you're up to?
We've been in Europe now since 2014, largely in logistics, but in the last few years, we've made a presence in credit with first lending in our debt fund. We're increasingly active in the data center side, acquiring a site in West London. And our UK build-to-rent strategy that we've been at for a few years. After a challenging market environment for the last few years, we kicked off a number of new developments last year on the logistics side, and we feel like things are getting cautiously to a point of making sense in terms of development. Credit's made sense for a while, and we think that this is the start of a new cycle that gives us some enthusiasm.
Yeah, I know Affinius is an absolute beast. I think 62 billion AUM. Before we kind of get onto that and unpacking who Affinius are, the different strands and kind of USPs of the business, how and why did you get into real estate in the first place?
Yeah, like many by accident. I grew up in the San Francisco Bay Area, actually near Napa Valley. My father was in construction, so the built environment always appealed to me. I spent a lot of summers on job sites with him, picking things up or hammering and just feeling the tangibility of real estate. So it was always a little bit my blood. My background was a little bit interested in that in my high school time. So my formative years, I went to Germany as an exchange student. Was the only American in the school, spoke German, had an incredible time. Was fortunate to have received a scholarship to do that. And then came back to the Bay Area, went to UC Berkeley. Didn't know I wanted to be in real estate, did a very short stint in consulting. I realized I was never meant to be a consultant. Nothing against them, but I recognized that the job was not to necessarily solve the problems, but prolong them for as long as possible, and never fully solve them. And frankly, when the tech market imploded in 2000, I had an opportunity through a relationship to join a public REIT on the office side in the San Francisco Bay Area. And at that time, the office market, tech market was very buoyant. That ended quickly. I stayed on after the REIT was sold to Equity Office, to Sam Zell, and continued really in asset management, which was a great education, understanding the asset management side, how it operates, how you respond to your customers, learning that side until ultimately I get into the acquisition side, the kind of more the deal side, and continued with that with a Seattle-based firm, really running West Coast acquisitions development, great run up until about 2007, 2008, and then quickly became a disposal officer, because there was no more acquisitions given the redemption queues. And really honed, my learning over that period. I think many of us at that age in our 20s got what we affectionately called battlefield promotions, where we were cheap and could do things and were promoted before we were necessarily ready. And it was a great experience. And then fast forward to 2011, I joined what at the time was USAA Real Estate, now Affinius Capital.
So before we come on to that, something I just want to unpick, it's quite unique, is the fact that you went to Germany when you were 16. Mm-hmm. Have you always, had a kind of an ambition and a drive for kind of more or other or an alternative path?
I think everybody at one point in their life has a teacher or somebody that changed their trajectory. And I had a teacher in 10th grade who said, "Why don't you apply for this scholarship?" I think it was all 3 pages. I think I hand wrote it. And in the post, maybe a month later, I got a letter saying, full ride to Germany, 300 Deutschmarks a month, live with the host family. And I think it changed my life in many ways. And that teacher, Mrs. Thomas, I still remember, kept in touch with her, put me on a path that it really expanded my horizons. And I think in life, we all have that person. What it did is really create ambition to come back to Europe, which is in many ways why I'm here now. The university experience for me was tame as compared to others because I'd already been abroad, really been on my own, and enjoyed life. This was pre-mobile phones, so I remember calling my parents every 2 weeks. Yeah, it was quite a liberating experience.
But also, you learned German when you were there, right?
Yeah, I had to.
You had to, which is quite rare for an American, dare I say it.
Yeah, there are some of us who speak multiple languages.
And were you a good linguist? And did you want, was that part of the attraction to go?
I think at 16, you just have that brain plasticity that helps you pick up languages. So I would say within about 3 months, it was fluency. Well, number one, I needed to graduate. So it was a condition to kind of see it through and have friends. And this was the 90s. The level of Duolingo and things didn't exist. So if I wanted to have a life there, it was an absolute necessity. And so picked it up quickly. Absolutely enjoyed the time there. And, I came back to the States, went to, as I said, UC Berkeley. Did not major in real estate, and but just continued down a path. It was actually my father-in-law, or to-be father-in-law at that time, who encouraged me to pursue real estate. I sat in an office with him, and he was tough on me, and I learned quickly. And even in my 20s, was doing principal deals, doing 95% of the work for 5% of the carry. Usual.
And he was in real estate, your father-in-law?
He was, yeah.
And so that was, kind of the combination of your dad being in construction,
Correct.
that kind of opened your world to the idea of real assets. Right. And then kind of through your travels and just kind of thinking around where your skill set is best going to be utilized, your future father-in-law kind of helped kind of capture that and set you on a path.
Yeah, I think there is a theme of built environments or construction for sure. I still remember growing up with my dad. We'd drive through Napa Valley and he'd point to a winery building and say, I built that, or that. There's just a pride with, and I think this continues in a lot of the business that we have today is your next building is always your best one. That you always want to make it absolute best for the customer and the community that you build in, and just enjoy what you do rather than just build commodity and continue with that idea.
And did you always want to be a principal, or did you kind of just, fly under the wing of your future father-in-law, or did he kind of set you on this particular path? Or because there's lots of different routes and ways that you could expand your career in real estate. Obviously, you said your father was in construction, but advisory or brokerage or management, or
I think I was always driven to the deal side, whatever that might be. I was not in brokerage. I think it would have been a great learning experience. I was more on the asset management side, which was incredibly helpful on the deal side. I still find, because you know how it actually operates, you know what it looks like after you've PC'd it and you've moved on. And that's critical to think about how the expenses flow through, how you retain the tenants and continue on that journey. And so I think it's been a fantastic piece of it. I've always been aspirational, so it was always probably in the cards that I would want to be on the principal side.
Talk to me about the kind of the journey through Kennedy and then Bentel Kennedy as well, and what some of your reflections and learnings were.
Yeah, so I joined Bentel Kennedy, or at the time was Kennedy Associates, in 2004. Smaller manager, Seattle-based, did a lot of what was called Taft-Hartley investments, which is union pension fund investments. So particularly liked it because there was a lot of development. It was putting union labor to work. So great learning, a lot of industrial logistics that we did in that, quite a bit of office, and really learned at that time was San Francisco Bay Area, so Silicon Valley, San Francisco, Portland and Seattle markets, a little bit in Reno. But it was, I think I got bonus points for considering something out of the box.
And then in terms of kind of the evolution and the journey from asset management into transactions and kind of working across principally equity focused strategies, but kind of cross sectors, cross geographies or kind of states in the US. Is that fair?
I think that's right. Early part of my career was all West Coast. So, and a lot of tech focus. So obviously Seattle, San Francisco Bay Area was heavily office focused. And that was probably a bigger part of the first 10 years of my career. Always some industrial logistics sprinkled in there.
Yeah.
But clearly when your mandates or your motivation is capital deployed, office was the easier ticket, just due to quantum, just due to scale.
And what you mean specifically by that is fee revenue and...
No, just as an acquisition officer. Yeah, it was much easier to do a $250 million office transaction than it was a $40 million logistics transaction.
Fine. So just in terms of efficiency, just
absolutely.
Kind of bigger ticket type sizes.
Yeah.
You left Bentel Kennedy in 2011, went to USAA. USAA, sorry.
Yeah.
Talk to you about who they were and their business and why they were, how they were set up, how they're capitalized, what their strategy was, and what you were involved with.
Yeah, so early 2011, I got a call that they were looking for a West Coast person for USAA Real Estate. At the time was a 25-year-old company, started in 1982. And the call was from the CEO, Len O'Donnell, who I still work with. And at the time, they didn't have an office in San Francisco. And the then current CEO before Len said that they didn't need to because they hadn't done any deals in those markets. So the first part of the interview was just a laugh that there's a reason they hadn't done any deals in the market without presence. But I really bought off on Len and the larger team's story of having a really wide moat defensible balance sheet with USA that wanted to scale that opportunity coming out of the GFC. 2011 was a very ripe period to invest into distress, into recapitalizations, every kind of value creation. And what the story was, when others couldn't, they would. And that ride from 2011 till about 2014 was a fantastic one. Growing relationships, buying things out of bankruptcy. And then every deal during that period, everything was interesting that we were doing. And as part of that was to use that great balance sheet and the ability to act to bring in other investors with us and grow out a full-fledged investment management business. What's exciting is 15 years later, that journey from $3 billion of AUM when I started with Len to 62 today, as you said, was due to being creative. Yeah, every 2 or 3 years, I feel like I haven't had to change my job because it's been a new one. It's been something different strategy, different pivot that we've made, and grown the customer relationships. And customers are the capital we serve, and in many ways I think the nice thing about coming from USA is that it's a military-backed insurance company, and everything that we did was for the service of those members. Yeah, it was last I checked about 12 million members. And that also applies to the service that we provide to the pension fund holders and all of our investors. Is our investments have meaning to their pensions, and even the sovereign wealth funds, the beneficiaries of those. It does matter what we do, and to keep that DNA in the business is critical.
How did USA create? You touched on kind of a balance sheet with a rather flexible remit that by the time you kind of joined it was going 25 years or something like that. How had it just kind of built up and reinvested? Or what was kind of the genesis of that business? Or did it have a relatively small balance sheet, but it had, quite broad ranging mandates with a flexible remit that it could co-invest and do interesting deals on?
At the time, it was wholly owned. USAA Real Estate was. So we invested the capital on behalf of their balance sheet as well as a number of other investors and grew that over time. With
just a very flexible kind of remit and discretion over
different
smart risk-adjusted deals.
These were 50-50 joint ventures. It was really all over the map that we could do. But and we took that same mindset with all of our investor base. It wasn't just USA and isn't today.
And so the journey from 3 billion to 62 in 15 years is vast. How did the business kind of go about doing that realistically? Because, I'm just trying to sit, and think about that kind of journey over 15 years. You've got to have a monster amount of kind of vision and ambition to be able to turn a business from 3 to 62?
I think there are a couple key themes there. We grew a credit business that today is about a third of our AUM and has been a huge contributor to the story. Certainly for the last few years when credit's been, frankly, it made more sense and has been much more in favor with the investment market. That has created great balance to our business. Yeah, when equity maybe wasn't in play, we'd stepped in credit, often with the same relationships. We maybe weren't joint venturing with them, but instead we'd lend to them or create some kind of solution through that. That story over the last 15 years is a combination of a lot of different things. Some of those being strategies, including our going to Europe in 2014. That's been some of the growth there, but it's been growth of different vehicles in logistics, in data centers, in residential. Some we've turned on, some we've turned off, but it's just been a kind of a constant feeling of how do we expand these relationships and continue to grow. One thing I'll say is we are not a AUM by any means type of shop. If anything, the thing I'm probably most proud of is we create alpha throughout. It hasn't been just grow with core. It has been gain oriented still with income alongside.
And in terms of your role, you said you haven't had to change jobs. Your kind of job has evolved every 2 to 3 years. Just talk to me about your kind of personal journey and what you meant specifically by that. And I think, one of the key things is kind of coming back to Europe as well.
Yeah. So I started the firm in 2011 in San Francisco. I was office of one, running basically the Pacific Northwest. I added a colleague with time, relocated him from Dallas, actually. And then after a few years, the business was going well. We were adding new strategies, really developing, acquiring. And then about 2015, after we've had the European business already up and running, I didn't start it. A colleague of mine started up first start in May of 2014. I did put my hand up and said, look, I speak German. Family is up for a move. I think this is a great opportunity and challenge. And we'd done only a couple transactions with Mount Park at that point. So I moved it was June 24th, 2016. Just another day, but it was also the day of the Brexit vote. So I remember texting colleagues, talking to my wife, saying this is either the best decision I've ever made or the worst decision. The truth is it's been somewhere in between.
Appreciate the honesty.
Yeah. I don't think it created the distress that we expected, and in some ways it created the opportunity. There was an immediate buying opportunity coming out of Brexit and development opportunity that we capitalized on. And, I think those that are willing to learn in Europe and dig in and really kind of peel back the opaque data that's out there, there's a lot of opportunity. My move over here was frankly intended to be a typical short-term expat stay. And, it's now coming up on a decade. My kids have grown up here. We've essentially become native and have thoroughly enjoyed it. And, everybody asks the Americans, when are you going back? It's a really hard question to answer. We made a home of it here. And, my best friends are in the industry, and I think it would be difficult at times to consider going back because I've missed a cycle. Yeah, it's I'm here.
You're here.
Yeah.
And you're laid down roots. So just talk to me about the expansion to Europe. So you funded Mount Park, or did you take a slice in their business as a minority? How did you kind of enter the UK and European market? And then talk to me on the journey about how the business has grown outside of just that initial Mount Park transaction into kind of wider strategies as well.
Yeah, so early on in the business, there are a couple of reasons we looked at Europe. And it was really just in logistics initially. It's a property type that we've been in for going on 30 years now. We were in it way before it was cool. And we saw that coming out of the GFC, the recovery in Europe was delayed as compared to the US. And when it came to logistics, it was a very fragmented sector. There were relatively few pan-European players. and it was difficult for capital to access it, other than a few large players like Prologis and others. And furthermore, some of our investors said, we've enjoyed investing with you in the U.S. Would you consider going to Europe? We would like the experience we've had with you in the U.S. in Europe. And so a number of my colleagues interviewed the different development teams, really everyone across the sector, and found that the one common theme was John and his team. He'd been around. He'd kind of sold platforms twice in Europe, and in a way could kind of get the band back together and build a true pan-European platform. Then we created the joint venture to build on that. Really started initially UK, CE, Germany focus. With time, we expanded to France and Spain. Affinius did a number of deals in the Netherlands with another partner, which is something we've done along the way with it not being just Mount Park. And, really created a decade-long period of great investments. I owe a lot to John and others in the Mount Park team for bringing me under their wing and learning of them and getting to know, most importantly, the relationships and the market practices here. And, I think what happened with that, the venture is, with time, we liked the experience. So in 2019, we bought a larger stake in the operating company, in the Mount Park Development Company. I came in a more significant way with the developer. So I wore two hats, both representing the capital for Affinius and then also in the business. Experienced a great period of development during COVID. We always realized a number of investments, sold along the way, created proof of concept. And then ultimately in 2024, John and I had a lot of discussions, and he wanted to move on, really deal with his family office and exit the business. So we figured it out. And for the last year and a half now, roughly, it's been wholly owned by Affinius Capital.
And Mount Park then sits effectively as the European logistics big box development and investment arm of Affinius, or?
That's right to an extent. We're, I'd say, mid and big box. We're opportunity led, so we've gone small, we've gone mid. It depends on where we. Yeah, they always say it's the Wayne Gretzky quote. We go where the puck's going, not where it is right now, and try to see where there's a scarcity or an opportunity. We try to lead to that, but we've certainly done some smaller schemes, and it's been a fantastic ride.
So at the moment, you kind of sit as senior MD and head of Europe for Affinius on one side, but also CEO of Mount Park and kind of responsible for driving that as well.
Yeah.
And then if we think about kind of the other parts of the business in terms of growth, you're into data centers, credit, and living as well. Can you just talk to me about how you've grown with your Affinius hat on, that exposure, and what the kind of the plans are around those
I've
parts?
grown a nice hat collection. So yeah, I do oversee all of that. I'd say throughout this, the reason that I'm able to do this because I've got great teams. That's been the one consistent piece. Is one of the most overused words in the corporate environment is communication. They tell me what's going on. I can check in and out, but I do my best to stay out of the weeds, and that is how I am able to do a lot of this. I'll go through these in no certain order, but data centers, a theme that we really dug into starting in the U.S., just seeing the rapid growth of data itself, as well as need for data centers. And that is one general theme we picked up as a firm, is this convergence of technology and real estate, be it e-commerce, logistics, to some extent life science, science and real estate. Data centers certainly, and the I talked about the hockey stick of the demand curve that keeps going up. And we started to look at how we would execute in that. Similar in some ways to Mount Park, we knew that we wanted to be in the execution capability, not just funding. So we created a vertically integrated platform named CoreScale to source the land, have the relationships with the hyperscalers, see it through planning, really the full spectrum of execution capability. A few years into that strategy, we identified that we in a similar way we've done in the US in logistics, we would want to have European exposure as part of that too. So we identified it's the flap D markets, Frankfurt, London, Amsterdam, Paris, Dublin, that London would be at the top of that of where we'd want to focus in the dominant cloud market. So as I have to explain to a lot of my American colleagues, UK planning in particular is a little bit of a journey. We started on a site in 2021 that in late 24 we got planning on, post-Labour election, and it being overturned by the Secretary of State, our denial. And then about a year later, we acquired the site. And now 140 megawatt site in West London that we're seeing through, and something that we're incredibly excited about and continuing on that journey in a data center growth and building out a platform on that over time.
So how did you unlock the planning, get it overturned and get it consented?
In UK planning, there isn't one way. We did demonstrate that we would build a building that from a visual standpoint would be attractive along the M25. But we also looked a lot at how we could use less water. And I think one key determinant of it is it was a site that had a lot of traffic for kind of light industrial use, that the data center use would generate much less traffic. So it's being responsive to the needs of the community is something that we focused on there. And I'd say persistence is in many ways how we got there.
This podcast is powered by Rockborn. We help real estate funds, owners, investors, and developers hire better quality leadership talent. So, if you're open to trying a different recruitment approach, head to rockborn.com for more information. So that's your data center arm and the data center side of the business. And then talk to me about the living exposure that you have, in that particular market.
Yeah, living is a theme that we have been on in the U.S. for a long time. It built, I think it's over $10 billion of residential over the last decade plus. And so we came to it with a fair amount of operational experience, design experience that we thought would benefit the UK in particular. That experience in thinking about amenitization and how the industry will professionalize. We knew that we didn't want to do it ourselves, and so that one we took a joint venture route on with a great team with Package Living. They'd been around in that sector for a while. We really like Ed and Mark and the team. And I think what differentiated us is we're willing to take a little bit of risk on land planning, given our journey in logistics, that we were willing to take that on. And that allowed us to buy sites without planning in some cases at a much cheaper basis. I think that's a business that longer term, this country is so undersupplied in housing, and not just that, a lot of the existing housing stock is either not fit for purpose or not modern in some way. And so although the industry may be going through kind of teething pains over the last few years, the tap has to be turned on for more housing, especially in urban areas, and not just London. So it's a sector that we leaned into. We're still committed to see how that we can build that out and build a portfolio around that. It's been one that perhaps is more sensitive to yields, as over the last few years, but we're still a believer.
Jonathan Ivory, CIO at Package, has been on the podcast, and he kind of said at the time, they're looking at expanding into Spain.
Yep.
Are you kind of backing him to do that? And are you kind of interested in the kind of the European market as well from a living perspective?
We're not with them in Spain. We are on the logistics side with Mount Park, and we like that market and the growth prospects a lot. Early in our investing in Europe, through one of our affiliate opportunistic vehicles, we bought a portfolio of squatter-occupied residential units in Madrid and Barcelona. That was called Project Paella. That one was a journey in terms of how you deal with cash for keys and manage a very operational intensive strategy. Perhaps that changed our view on residential in Spain, but I think the opportunity there with the population growth has legs. So we're rooting the package team on that, but not in it.
Not directly. Yeah. So data centers, logistics, living, and then talk to me about the kind of the credit side of the business as well, because you kind of said it's about a third of your kind of total global AUM. Talk to me about the kind of the credit platform in the UK and Europe.
So about a year after I joined the company, we bought a stake in a company called Square Mile Capital, New York-based opportunistic investor and credit investor, and we really saw that platform as one we could help grow a credit exposure to complement our equity background. It's been a really exciting growth story in the U.S. in that strategy. Effectively, we seeded with about $300 million of capital, and over the last 12 years, we've deployed, I want to say, about $55 million in debt strategies over time, and it's grown to today about a third, about 20 billion of AUM. We have similar ambitions, maybe not as grand, but if you ask my team, they are that grand in Europe. And the timing now, there's a lot of debt funds coming in the market, given the changing regulatory environments, and a need for that transitional capital, be it development, recapitalization, whatever that might be. And I think it's really led to a lot of the equity recovery has been that the debt's been able to, well, on one hand, reduce margins, on the other, go to a little bit higher detachment points to allow the deals to make sense.
As in kind of extending the terms or just being a little bit more creative or flexible in terms of the parameters?
To some extent, the LTV levels, but also the groups that have an equity background are able to go in and understand the story and de-risk the thinking around it a little bit. And that's been our story as well. We look into the sponsorship, we look into the overall story, the market, and take a view that this will lease or not, and buy into the business plan. And so it's really, it's a credit thinking with an equity hat on as well. And we're able to take that view, and we intentionally set up the equity business and built out the infrastructure prior to credit so that the equity business will support the credit business and what we do. But I think in general, how all these things tie together is, I know it's working when I get a counterparty into a room, and we usually say, not sure what it is, but there's going to be some solution we're going to provide for you. We're going to joint venture, we'll provide debt for you, we'll buy from you. There'll be some kind of way that we might work from you, and that's a little bit of the Affinius DNA, is because of all these different entry points into a transaction, we can be pretty malleable to how we might work with groups. And that often does work where we may not do a certain joint venture or development opportunity, but I will pass on to my credit team and they may find the solution just at a different point in the stack. And that becomes really fun.
Yeah, I want to unpack that a little bit further. But before we do, just talk to me about the mindset around credit and underwriting, doing credit deals versus doing equity-focused deals, and the kind of, the different hats or the different kind of viewpoints or vantage points that you need to be mindful of when you're looking at those particular deals.
Yeah, I think one thing that's in our DNA is quality matters. So we're unlikely to want to lend on something that we don't believe in the quality, be that location, sponsor, asset, any of those. So that's usually the first test. Frankly, on credit, you're at a different point in the capital stack, different detachment point. While we may not love an opportunity at 100% equity value and the return that generates from that, but we might like it a lot at 65. And although we're not intending to ever enforce or take that asset back, if we had to, we feel there's a margin of safety and comfort there, while still generating a return on the credit investment that is attractive for that point in the capital stack. A large part of our credit strategy includes working with back leverage. So we effectively create the mezzanine piece in that. So we'll speak for the whole loan, and then often we may sell off the A piece to another bank or investment bank, whoever it might be, insurance company. And then we retain that middle piece, that retained piece, that may be on average from 50 to 70% LTV. Through the creation of that, we can have a really nice return that's somewhere between the senior loan and the equity, with like I said, a nice margin of safety around that.
Yeah, I guess from an LP perspective, if I'm not mistaken, you kind of got over 150 LPs that kind of
That's about right, yeah.
And on a range of different structures, from kind of fund structures to separate accounts to clearly a very strong balance sheet with a flexible mindset. How do you kind of finance or fund or where do you kind of draw down capital from, and how does that? How do you think about that? Just given the kind of the broad church or investable universe that you can kind of access.
I mean, those investors are global in nature. A lot of them have been with us for well over a decade. Some have grown from a single transaction to billions together. That is what we always aspire to, is to grow with them. It's a shame when they may come in one vehicle and not in for the next. So that's that culture of service that we try to talk to, that through that communication and good returns, that we stay with them. We're hard to pin down on the type of structure that we do. Some of these can be funds of one, some of these can be large commingled vehicles, 50-50 JVs, where some we may have a significant balance sheet investment, some it may be more modest in nature on the request of that investor. Difficult question to answer, because we're overly flexible when it comes to that, to figure out the right solution in that case.
Yeah. So if we take a bit of a step back and we kind of think about the kind of the European context, what's your kind of view on the European market now? What's your kind of take with obviously a real estate perspective? Where's the opportunity and what are some of the challenges?
Yeah, in some ways it's not drastically different than it was 12 years ago when we started. The differentials in the market, the fragmented nature of it still creates opportunity. The data has gotten better, so it's less opaque than it once was. But, I think we're building now on the next cycle, next opportunity. Continental Europe is starting to come together and think, obviously in reaction to a lot of the geopolitical events, and how it can spend on infrastructure and defense and other things. Rent growth in a lot of our portfolio is picking up. Yields are stabilizing. The building blocks of stability are the first step to expansion. And it does feel like we're there at this moment. There's some parts of the valuation story that I think there's a bid-ask spread that the market always seems to do early in the recovery cycle. And that has to get unlocked to be able to really pick up momentum. But I think one thing that we've seen in the market is transaction volumes are actually quite high on a historical basis, but we just got so spoiled during COVID that things were off the chart, that everything in comparison seems, depressed. We were never going to stay at the yields that we were at that level. They just weren't simply sustainable. So it's an adjustment to the new normal, which takes a few years to kind of lean into. And we may, if I had to pick a period that it starts to feel like we're in now, it's about 2014, 2015, maybe heading towards, that pre-COVID level.
Yeah.
That was not a bad vintage to invest into, assuming you didn't rely on yield compression. It's a more of a stock picker's market. Pick the right locations, pick quality. The one theme that we're seeing is definitely a separation between grade A quality and something that may be more obsolete. So the era of just buying large portfolios and assuming you create a premium through that, it may come back again, but it doesn't seem like it's in the near term.
So it's kind of first principles, back to basics in terms of kind of quality, stock, location, with a kind of robust capital stack, and just making sure you're not just solely reliant on yield compression, but driving rents forward, having really strong kind of asset management, development management capabilities to really, improve and drive outperformance and mitigate risks is really what's gonna.
It's old school. It's actually kind of exciting to think about. These are the ways that you stick to your vital thinking on not development but everything. I think what everyone is waiting for is a little bit more liquidity to come in the market, certainly in the core space and elsewhere, so that if you develop, there's a core takeout. There just in certain pockets of the risk profile, there's less depth. I think that's what we're waiting for.
And have you seen a change in capital makeup looking to access the European market from various different geographies, or more kind of private capital versus institutional capital? Can you talk to that?
Yeah, over the last 10 years, capital has become much more global and institutional in the sectors that we deal with. I'd say in the last year, Europe has started to at least think about investing more within Europe. And again, that's a natural reaction to some of the global phenomenon. Seeing that really kind of lead to new commitments is happening in real time. And the capital has become more mature and more institutional in nature. We've definitely seen that, and they're asking better questions. I think that what we're seeing in data centers and credit, they look at the whole spectrum of what they can invest into, and with change to the office investment market and other things, they've had to rethink their strategies, and they're pretty astute.
How do you see Affinius Capital scaling its business further? I'm sure there are aspirations to get to 100 billion and beyond. But if you kind of look at your internal structure and the ways in which you access the market, what's the kind of the playbook? What do you think is going to kind of work in the next cycle, and how do you think about that?
I think these macro trends that we're talking about in the property types we're in will continue to grow those. Given that we're not going to be in a yield compression type environment, there's good reason to hold assets longer and continue to asset manage them and see the income through. So that will bring some natural growth in our AUM. We will likely be a little bit more development led, just because we're quality snobs, and it allows you to control that when you develop. I think in logistics, the e-commerce story will continue to grow, particularly in some of the underserved markets like Southern Europe. Supply chain reconfiguration, the defense story, all those tailwinds are starting to come into place to create further growth. And as new development is curtailed, vacancy levels have come down, all the things that we're seeing kind of happen in real time. I think the residential growth story has to happen. Otherwise, there isn't sufficient housing with the growth story, and rents will there'll either be regulation or there'll be natural curtailment of rent growth with just more supply. And that is a more common way to deal with it. It's just build. Data centers, yes, that just needs more power. That's an infrastructure issue that we have to see through. So certainly not, I don't know if you mentioned 100 billion. We're not aiming to be there. We don't need to be the biggest. But I could see us being significantly larger than we are today, just through these different pillars, and growing the right teams and the leadership behind that, and continuing to focus on quality and service to both our tenants and our investors.
And you'll do that still through flexible kind of structures, whether that's JVs or clubs or kind of platform plays that you'll kind of build up that will be under a separate brand or business, and as you kind of look to kind of scale and deploy capital effectively into the thematics that you like?
I think we'll always be open to opportunities. So, what the different operating platforms we have do might change with time. There may be reason to bring them together or have them be more collaborative with each other, and that there's a lot of flexibility in that. Who knows what will come? I think I mentioned at the beginning, about every 3 years, I feel like I have a new job. So something may just fall in front of us, and we'll take advantage of that type of opportunity. The things that we respond to, and we've never had any sacred cows of things we don't do. We'll evaluate it. We'll say no quite a bit, but if it makes sense, we'll strongly consider it.
Give me an overview of the Affinius team in the UK and Europe. How many people are you? Where's the office based? And also in terms of kind of global headcount as well.
So European headcount is about 60 between Affinius and Mount Park. we count, and Corescale, we count those in as affiliates. We're about 20 in the Affinius business, most of that in Amsterdam, but then a few of us in the credit business and myself in London. Mount Park is spread between, so a combination of London, kind of a little bit in Amsterdam. We consider that team part of it. Luxembourg, Madrid, Paris, Prague, and Warsaw. A lot of those regional offices are boots on the ground. They're sourcing the opportunities. They're seeing the developments through. They speak the languages. They have the relationships. They're the people I rely on to kind of drive the business, and that's the exciting part. Is my Mondays are often hearing about everything they're going to work on during the week, and that's kind of gets me excited.
So what are you hearing about the US market and the opportunity over there for kind of the listeners that are sat over here in the UK and Europe who are intrigued or are interested in what's happening back home in the US?
Yeah, sure. It's I sit on the global IC, so I do get to see all of our equity and credit opportunities in the US. It's a mixed story, but there's a lot of reason for optimism. Similar to the story we're seeing in Europe, the credit markets are leading, which is kind of the leading effort in the recovery story. And so that's allowing arguably some deals to blend and extend and kind of build the time in to stabilize and see it through. Maybe some juxtaposition. The office market is in a much worse place in the US as compared to Europe. There's reasons for that. People may not go to the office as much. Logistics is starting to make a strong recovery. The one thing the US is able to do is develop quickly. There's less planning challenges. And so a little bit of the overhang may be around longer there as compared to Europe. And then, residential development has curtailed quite a bit, but has proved to be stable. Frankly, some cap rates, some yields that are quite low as compared to what I expect in comparison to the 10-year Treasury. But I think in general, it's still a delayed recovery and dealing with a lot of the same things as Europe deals with. I remember a year ago heading into MIPIM, enthusiasm was picking up, and then Liberation Day happens at the beginning of April, and it put a chill on a lot of last year. That was no different in the U.S. They felt a lot of that. I think one minor differential I've seen between the U.S. is that the valuations have not corrected to the same extent as they have in Europe. I think professional indemnity and some of the rigor that RACS and others put on valuations in this country and across Europe has caused that bid-ask delta to probably be narrower than it might be in the US in some cases. So for the first time, at least in my investing career in Europe, Europe may actually be leading the US to some extent, which we really haven't seen for a few cycles.
And combined with what you said earlier about more kind of inward focused European capital looking for opportunities as well.
Yeah.
It's an interesting kind of time.
And I think global capital is seeing that, be it the Australians, Middle Eastern capital, Asian capital is looking to Europe as a potential opportunity right now. It'd be nice to have a few more quarters of proving that out, but it does feel like there's a lot of interest in capital coming to Europe now, really across many strategies.
Kind of a key topic with a lot of the leaders that I talk to is kind of AI and optimization and driving efficiency. How do you see, given your kind of tech background and coming from the Bay Valley and your understanding, how do you see kind of the use case of AI in terms of kind of raising, managing, and deploying capital earmarked for real estate?
Yeah, I mean, AI, the one thing I found about technological change, be it e-commerce or every step along the way, is often it doesn't, it may make some jobs fairly obsolete, but it creates generally more than it ends up eradicating. And those jobs, we don't know of what they are today. I think some of the coding jobs are frankly being held by AI now, and so those will erode, but others might come back, and that disruption will continue. But tech tends to be a net job generator. I don't think AI will be different, but that's just my personal opinion, and it'll create further opportunity. In terms of AI in property, I think it has a huge amount of opportunity for sifting through information, decision making, refining how we underwrite, and do it in a more less clunky way than we might have done historically through Excel, and just allowing us to be faster and better and make better decision making in general. We're doing some exciting things with heat mapping when it comes to and looking at a lot of different data sets to figure out what the right locations are of the future and lean into that so that we can be more informed on land purchases. So there's all kinds of ways that we really hadn't thought about to test our gut decisions, to at least have something that you can test it against, and hopefully you're making a better decision out of that.
So as you look forward, how do you scale the Affinius business across Europe?
I think it's a little bit different by strategy. When it comes to the credit business, we are seeing the opportunity. We'll continue to lend, create more track record around that, raise more capital to come along with us as we scale it further and go with that. The one thing we've learned about credit is always be in the market. It doesn't, it's almost a dollar, sterling, euro cost average. Just be in it and go up and down the stack as we see comfort. With the logistics strategy, we will look to bring more vehicles and bring more investors alongside of us. With Mount Park in particular, we're taking a very intentional, flexible approach to that. There'll be many opportunities that Affinius Capital may back Mount Park and invest into that through different vehicles. Mount Park is open to working with other capital sources in development joint ventures. I love that idea of letting it be open to the market to make sure that we take advantage of all the opportunities that are out there, that we maximize the opportunity. And the team and I are really excited about how by working with the market overall, it makes us better and more disciplined.
Yeah, one of the key things from this conversation that I'll take away is just the flexibility in terms of the Affinius business, the fiduciary mindset, the partnership, but also the ability to partner with good quality partners and be able to provide equity, debt, and do various different kind of structures to meet kind of their objectives and their needs, but crucially the Affinius's needs and kind of your LP's needs as well.
I think that's right. We've always stayed an investor, and that part of our DNA has persisted since I joined 15 years ago. That I think I get slightly allergic when someone asks if we're an allocator, because that is absolutely what we're not. It's we understand the real estate. We want to be able to answer the question that one of my early bosses asked me, which was, who are we going to lease it to? Who are we going to sell it to? And everything in between, and having that mindset of being able to answer all those questions, the fundamental ones.
So Justin, if I gave you £500 million worth of capital, who are the people, what property, and which place would you look to allocate that capital?
Yeah. So obviously, just to cheat on the question a little bit, at least half of it goes to our existing strategies. So I'll take the other half, which is more personal and kind of opportunistic. I'd say the first 50 million, I'd think about this, and probably I found that a lot of the opportunity in Europe is in land. That frictional nature of UK planning, European planning. If you buy in the path of growth and power, you can make a lot of money in an opportunity. And being strategic about that and kind of creating a mixed portfolio of very targeted, let's not call them bets, is a great way to create great multiples on capital. Next, I would probably put 50 million, call it euros, pounds, in platforms. I think the best way to get to opportunity is by building teams and creating brands around those, sort of what we've done. That could be building new ones, growing existing ones, M&A, whatever that might be. I think this is a market that still creates a lot of opportunity to create new ideas and growth around that. I think urban mobility is a really interesting strategy, one that we're starting to explore with Affinius and Mount Park. And autonomous vehicles will be a very significant growth sector. So urban land that's powered, that can adapt to that need. Coming from San Francisco, where about 30% of the market share is Waymo and basically autonomous cars. It's coming to Europe. I think in our lives, the need to own your own vehicle may not exist, in 20 or 30 years. That change is coming and extremely exciting. And I think creates a real lifestyle change in being able to take your autonomous car from central London to the Cotswolds for dinner and come back whenever you want. I'm really excited about that change in the difference in lifestyle and how that flows through all of real estate and use of it.
That sounds like a dad who's got 2 teenage daughters who knows all too well what being a taxi driver is like.
I do. Yeah, a lot of my weekends are shepherding them from sports or friends' houses. But no, I think mobility as a theme for real estate is something to narrow in on and be really excited about. And, they've also seen, imagine it. You get into a Waymo in San Francisco or, there are other competitors to them. It's your space. You control the radio. There's a safety element. Single women can use it and never have to worry because it's just them. I just think that product is coming and really exciting. So I think that's a trend that is early for Europe, but it's a reason to focus in on it, and we'll continue to do that.
So land, urban mobility, autonomous cars.
Yeah, so I think I've got 100 million left. The two that I put a lot of thought about, a lot of my background and upbringing were in the tech markets. I think technology has not really come into construction real estate to the extent it should. If you think about how we build a home, if you think about how we build most of what we do, the technology hasn't changed drastically in the last 100 years. You can't say that about a lot of the sectors of the economy, that there hasn't been some significant change. So these buildings take too long to build. The supply chain is far too fragmented. There's just room for opportunity. And also I think about, sustainability factors. We use too much of the materials. Just using less of it would be much more sustainable. So I'm a big believer in just finding better ways to build. Will improve, and actually there's opportunity for a lot of opportunity to make money out of that. And so I think there's some exciting things happening, and things that some may find boring, like concrete, like, cladding, roofing.
Modular,
yeah. So built offsite, then brought in and built quickly. A lot of that becomes really exciting. And I think, we're at the start of more of that coming into the acceptance of the industry. The last one I'd state, pending peace in Ukraine. I think investing into Ukraine with knowing that that's the breadbasket of Europe, knowing that there is a highly educated population there and a lot of opportunity. There's a lot to do, but whether that's the next Marshall Plan or whatever might come out of that, I'm hopeful that there's a lot of opportunity in a country of circa 40 million. Energy, there are all these elements that just seem like opportunity and doing the right thing for Europe that I'm excited about. And, I hope I have the opportunity to invest in that country in my career.
So that was kind of 250 million. That's the other half of it. And then the other half would be the kind of the existing strategy. So kind of credit, residential, data centers, and logistics too. So,
and I think that fits with my personal and probably the Affinius mindset is do some things that you do well, but you always have the potential to add on to that. And it may not be 50% of what you do, but yeah, there is always an element to try some new strategy and create alpha through that.
Well, Justin, thank you so much for sharing a little bit about your background, the Affinius business, and also your kind of views and takes on the market. I've really enjoyed chatting with you today.
Cool. Thanks.
If you enjoyed this week's episode, do me a favour and send it to a friend or colleague. And if you've got any guest recommendations, hit me up on LinkedIn. I would love to hear from you. Hope to see you next week.